fund, right? So by the time the maturity date reaches, there will be sufficient amount of money to be used in the redemption, right? So it is the calculation is like a annuity, because we know at maturity what the amount exactly what we have to pay for a bond, right? So we can calculate the future value. Since we know the future value and the interest rate, we can calculate the annual or monthly payment that we should make to have that balance on the date maturity date of the bonds, right? It is called a sinking fund. So these are the one characteristics. Right? You can have a sinking fund for that. It has a maturity, it has a default risk, it has a face value, it will give you a coupon payment, right? These are the characteristics of a bond. So we are now interested is in how we should value a bond, right? How we should value bond. So financial asset valuation in common. Value of any financial asset is simply the present value of the cash flows the asset is expected to produce, right? So value of any financial asset is simply the present value of the cash flows the asset is expected to produce. Present value. Present value of the cash flows that the asset would produce. That the asset would produce. Present value of the cash flows the asset would produce. Now, if it is for a bond, it's the coupon payment, right? So if it is for a share, it's the dividend. It's the dividend. Okay, so it's the dividend. Then zero coupon bond will generate one cash flow at maturity. Zero coupon bond, which is called a bond that is called a zero coupon bond is at the time of purchase of the bond, you receive a discount. You receive a discount, right? Say, for example, you are offered a bond that has a face value of 1,450, 850, right? So you pay 850 and purchase the bond which has a face value of 1,000 rupees. Say, for example, it matures in 1 year. So at the end of 1 year, you can claim 1,000 rupees. So the benefit of that investment is the discount that you got. That is, you pay 850 in place of a bond face value of 1,000. So the benefit or the interest is 150, right? So that type of a bond is called a zero coupon bond, right? A zero coupon bond, but there will be no coupon payments in between. The benefit is for the bondholder. Benefit occurs at the time of purchase, right? So this is called zero coupon bond. Then a perpetual bond will generate a fixed interest flow forever. So you know what is the meaning of perpetual. Perpetual bond is a bond without maturity, right? So we said cash flows when we were talking about annuities. We said perpetuity is an annuity which doesn't have a maturity date or a stop date that the cash flows stop, right? Cash flows would flow the infinite future. And so perpetual bond, so therefore, is a bond which doesn't have a maturity. So since the interest rate is in general fixed, so it will be the cash flow will be in the form of a perpetuity. And so the bond will generate fixed interest flow forever. Right. So do y'all think that if I use the earphones, it will be okay? Is it? All right. Then, yes. All right. So I will. So can you all hear me now?
Yes, madam, we can hear you.
Okay. Clear?
Yes, madam, it is clear.
Okay. Okay. Thank you very much. I'm sorry for the trouble. Sorry for the trouble. So, right. So we have an example. ABC PLC has issued 1 year pure discount bonds with a face value of rupees 1000. If the required rate of return for an investor is 12% per annum, how much will he pay to purchase a 1 year pure discount bond of ABC PLC? So let us apply this rule, the general rule of valuation. Right? This is called the general rule of valuation. That is, this is the principle that we use in valuing any financial asset. The rule is value of any financial asset is simply the present value of the cash flows the asset is expected to produce. So let's apply to this bond. So has issued 1 year pure discount bond with the face value of 1000. So we buy it. As I told you, zero coupon bond will generate one cash flow at maturity, right? So we will receive 1000 rupees. Face value is 1000. So we are not told that at maturity you pay a different amount, right? Or redemption price. We are not given. So if it is different from the face value, they would tell us redemption price is this. But since there is no mention about redemption price, we will take it as the face value. Right? So if the required rate of return for an investor is 12%, that is the discount rate per annum, how much will he pay to purchase a 1 year pure discount bond? So, how are we to now find the present value of the cash flows? First, we must identify the cash flow. In a pure discount bond, you will have only one cash flow at maturity. In this case, this cash flow, the value of this cash flow is 1000 rupees. And we will receive it after 1 year because the bond matures in 1 year, right? 1 year pure discount bond. So bond matures in 1 year. After 1 year, we receive 1000 rupees. So this is the cash flow, and we must take the present value of the cash flow, right? So 1000 rupees has to be discounted at 12% for 1 year, right? Has to be discounted 12% for 1 year. So shall we do that calculation? This is 1000 rupees divided by 1.12 to the power 1 because it is 1 year, right? So what will be the value? What will be the value? Can anyone tell me the value, please? Can anyone tell me the value? Yes, 892 and 86 cents. 892 892.86, right? So which means that if there is a person who is considering purchasing this bond, the maximum amount that he would agree to pay for this bond is 892 and 86 cents and nothing more, right? Because we say value is the present value of the cash flows, right? Value of any asset is the present value of the cash flows that asset would generate. So this asset would generate only 1000 rupees after 1 year, and we will be discounting it at 1 year at 12% because we want to get the present value. So present value is 892 and 86 cents means that the value of this bond is this much, 892 and 86 cents. So in buying that, you should not pay anything more than that, right? So you shouldn't pay anything more than that. Now, say for example, if this bond is offered to you at 850, are you going to buy it? If this bond, now this is the value that you have calculated, right? Not the market price, but this bond is being offered to you at 850. So would you buy it?
Yes. Yes, madam.
Yes, yes, you would buy it. Now, say for example, the bond is offered to you at 897. Would you buy 897? Are you prepared to pay 897 for this bond?
No, madam.
No. Yes, right. So clear. So this is the maximum value you should agree to invest in that bond because it is the value of the bond, right? So another example, PQR PLC has issued perpetual bonds paying annual coupon at 14% with a face value of 1000. If the required rate of return for an investor is 13% per annum, how much will he pay to purchase this bond? Now, what is the nature of this bond? It's a perpetual bond, right? A bond without a maturity. Perpetual bond without a maturity, paying an annual coupon of 14%. So at face value, you get 14% interest. Face value is 1000 rupees. So for 1000 rupees, you receive 140, don't you? For 1000 rupees, you receive 140 rupees. Yes, interest or coupon payment, right? Paying annual coupon at 14%. So you get 140 on an annual basis forever because it's a perpetual bond. Perpetual bond is a bond which doesn't have a maturity. So if the required rate of return for an investor is 13% per annum, how much will he pay to purchase this bond? So can you all calculate it and let me know? Yes, because we have already learned how to calculate the present value of a perpetuity. Now, this cash flow is like a perpetuity. Yes. Shall we calculate it, please? Yes, it is 140 divided by 13%. Sorry, 140 divided by 0.13. Because present value of a perpetuity is the payment divided by R or the discounting factor. Right? 140 divided by 13% will give us how much? Will give us 1076 and 92 cents. Right? So thank you for providing the answer. 1076 and 92 cents. Okay. So this is the value of the bond. So if you are purchasing this perpetual bond today, this is the maximum you should agree to pay. Right? This is the maximum you should agree to pay. Okay. Then there are another type of bonds. Now we talked about two types of bonds, zero coupon bonds and perpetual bonds. Now there can be bonds which pay a coupon, right? Which pay a coupon that has a maturity, right? And has a maturity. A coupon bond will have two types of cash flows, right? One is the coupon flow and the other is value at maturity. Now, in earlier cases, in the zero coupon bond, you had only one cash flow. In the perpetual bond, you had only one, say, only the coupon flow forever, right? But in this uh, type of bond, a coupon bond, there is a coupon flow, right? Coupon interest is being paid, say, for example, on annual basis or semi-annual basis or quarterly basis. And at maturity, you get the value that you deposited or you paid to purchase the bond. Right? So there are two types of cash flows. So if you have two types of cash flows, then to ascertain the value of this bond, you have to convert both the cash flows to the present, add those two together, right? And those two together. So let's have a closer look at it with the timeline. So value at time zero or value today is equals to the present value of the cash flows generated by the asset, right? Cash flows generated by the asset or the bond in this case. So let's do one example. What is the value of a 10-year 10% coupon bond? If the discount rate is 10%, face value is 1,000, right? Now, this is a 10-year bond. This matures in 10 years. So once issued, it will give you 10% interest for a time period of 10 years. Face value is 1,000. Interest is always calculated on the face value. So face value 1,000 rupees, 10% coupon will give you 100 rupees. So 100 rupees each you will receive for a time period of 10 years. And at the end of the 10th year, you will receive face value 1,000 rupees. So there are two types of cash flows. The coupon flow, which is the 100 rupees that you will receive for a time period of 10 years. And the 1,000 rupees, the other cash flow is the 1,000 rupees that you receive at the end of the 10th year, right? So you have to calculate the present values separately. You have to calculate the present values separately, right? Okay. You have to calculate the present values separately. So first of all, what we can do is take the coupon payment. Take the coupon payment. Now in the slide, you see you receive 100 rupees every year, and in the 10th year, you receive 1,000 rupees, the face value plus the interest 100 rupees. Now, 100 rupees, since it's the same amount, can be treated as an annuity. Can be treated as an annuity. So, you can use the present value of annuity formula to calculate the value of the coupon payment. Interest rate is at 10%, right? Interest payment is at 10%. So present value of an annuity equals the payment, which is 100, multiplied by 1 minus 1 over 1 plus r to the power n divided by r. Right? So r is 10%, n is 10 years. Yes, thank you very much for the answer. N is 10 years. And then the other cash flow, the 1,000 rupees that you receive after 10 years, is to be discounted for time period of 10 years at 10%, right? Time period of 10 years, 10%. So let's look at the calculation. I'm sure you are, although not familiar with the annuity formula, you can manage calculating the annuity. Is it? Or do you all want me to show the calculation? Do you want me to show the calculation?
Yes, madam, if you can, it's better.
Yeah, yeah, not a problem at all. Yes. Now, this is the coupon flow. 1,000 rupees, 10% you get 100, right? So present value All right. All right. I will tell you. Yes. So this is the present value equals. Now this is the periodic payment. So you calculate the present value. 1 minus 1 over 1 plus r. 1 plus r to the power n. To the power n. The whole thing divided by r. Right. So this is how it goes. Right. Right. So let's substitute the figures. Present value equals 100 multiplied by, right? 100 multiplied by 1 minus 1 over, right? 1 minus 1 over 1 plus r is now, sorry, r is 10%, is it? 1.10 to the power n. N is 10 divided by r again is 0.10. So when you simplify this, you can simplify this. When you simplify this, you get the present value interest annuity. Multiply it by 100 and then you get the present value of the coupon payment, right? What you get is present value of the coupon payment. Coupon payment, right? You receive that you receive in 10 years, right? After 10 years. So this is the second cash flow. This is the first cash flow. This is the first cash flow. And this is second cash flow. Second cash flow, right? So present value of after 10 years is 1,000 rupees divided by 1.10, that is the interest rate is 10% to the power 10 because we are discounting it for 10 years. So can anyone give me the answer for this and this and this? You add these two together, you get the present value of the cash flows generated by this bond, right? Present value of cash flows generated by this coupon bond, right? So in the earlier examples, there were only one cash flow each. For the zero coupon on the maturity value, and for the perpetuity, we had only the interest flow. In this case, for coupon bond, we have two types of cash flows. One is the coupon payment, the other is value at maturity, what you get from the company. Right? Two types of cash flows. So we have to convert both cash flows to the present value, right? And then add those two together. It will give you the value of the bond, right? So present value of this annuity of 100 received for 10 years, discounted at 10%, is 614 and 46 cents. So present value at maturity, that is 1,000 rupees discounted for 10 years, is 385 and 54 cents. Right? So when you add these two together, you get the value of the bond as 1,000 rupees. Right? So what you should agree to buy this type of a bond is the face value. Right? You agree to buy at 1,000, not more than that, and not more than that. So one person wanted me to give the answer to the perpetual bond. Perpetual bond. Answer to the perpetual bond is this.
Madam, can you repeat this answer again? Perpetuity?
Perpetuity. Yes, perpetual bond. Now, this is the nature of the bond is that the nature of the bond is that once you purchase the bond, there will be no maturity. Now, if the bond matures, you get your money back, right? So, bond without a maturity, you will not get your face value back. But forever you will receive a coupon interest rate, a fixed interest rate. So in this case, we are told that 14% coupon will be received. 14% is 14 per 100. So since the face value is 1000, we can always calculate the coupon rate on the face value. So 1000 for 1000 at 14%, you get 140. So 140 will be received forever if you buy this bond. So applying our principle of valuation, which is take the present value of the cash flows that the assets would generate as the value, right? So 140 is the cash flow. You calculate the present value. So calculating the present value of a perpetuity. Now this cash flow is in the nature of a perpetuity. So you calculate the present value of perpetuity by dividing the periodic payment by the interest rate. So discount rate is 13%. So 140 divided by 0.13 will give you 1,076.90. So this is value of bond, value of that bond. So you should not agree, if you want to buy that bond, you should not agree to pay more than this amount. So like in the earlier example, if it is being offered at 1,000 rupees, you better buy it because it really values 1,076. In the market, due to the market discrepancies, the real value is not decided in the market. So the price is lower. So it's a benefit. So you buy. It's a good buy. So you buy. Now, say for example, bond is being sold at 1,100. So you know that it's being overpriced. The real value that you have calculated is 1,076. 1,100 is an overpricing of the bond, and you should not buy the bond. Okay, you should not buy the bond if it is greater than this.
Okay, madam. Thank you.
Okay, so we were here. Yeah, at this place. Yes, yes. Okay, then let me please. What would happen if expected inflation rose by 3%, causing R equals 13%? So earlier, R was 10% in our example, 1,000 rupees at 10%, at 10% discount rate. Now, due to inflation, the discount rate has gone up to 13%, right? What will happen? What will happen to the price of the bond? Yes, can anyone make a guess? Yes, please. Can anyone make a guess?
Price will reduce.
Right, the value will come down. Value will come down because value is calculated by taking the present value of the cash flows. Right? Now, present value will decline when the interest rate increases or the discount rate increases. The present value of a cash flow would come down. Right? Now, earlier R was 10 and now R is 13. So when you discount it at a higher value, the present value will come down. Right? So when RD rises above the coupon rate, the bond's value fall below par. So it sells at a discount. So one thing I missed telling you earlier, in the example, the coupon rate was 10% and it was equal to the discount rate, which was 10%. So if the discount rate equals the coupon rate, the bond will sell at par. The bond will sell at par. So we saw it. The value of the bond is the face value, right? The bond will sell at par. So that's the rule that it's easy if you can remember these things. If the interest rate rises, the value of the bond will come down, right? And if the interest rate or the discount rate equals the coupon rate, then the bond will sell at the face value or sell at par, right? So what would happen if inflation
Recording stop.
Hello. Hello. Are you there?
Yeah, madam.
Shall we start?
Okay, ma'am.
Okay. Thank you very much.
Okay, madam.
Okay. So I'm starting again. So we were talking about the value of the bond due to a change in interest rates. So if the interest rate is equal to the coupon rate, the bond will sell at par value, or the value of the bond will be the face value of that bond. So if something happens like inflation causing interest rates higher than the coupon rate, greater than the coupon rate, the bond will sell below par, or we call it that it sells at a discount, sells at a discount. So what would happen if inflation fell and RD declined to 7%? Right? So we were here. So can any one of you tell me what would happen? If the coupon rate is greater than the discount rate, price will rise above par, right? Because when you discount at a lower rate, the present value will be higher, right? Present value will be higher. And the bond will sell at a, we say that the bond sells at a premium, right? Suppose the bond was issued 30 years ago. Suppose the bond was issued 30 years ago and now has 10 years to maturity. Now has 10 years to maturity. What would happen to its value over time if the required rate of return remained at 10%, 13%, or at 7%, right? What would happen to its value over time? Now it's a 30-year bond. Now it has only 10 years to maturity. That is 20 years has passed. What would happen to its value over time? Value over time. The required rate of return is return remained at 10% or at 13% or at 7%, right? So we can explain this, what will happen to it over time by using a graph, right? Now, in the vertical axis, you see the value of the bond, right? Value of the bond. On the horizontal axis, you see time to maturity, time to maturity. So at this point, at the starting point, you see it's a 30-year bond. You had 30 years left. After 5 years, you are left with 25 years. After 10 years, you are left with 20 years. Now we have spent 20 years and we have, at this point, we have only 10 years left, right? So this graph shows how the value changes over time. Now, if the coupon rate is equals to the discount rate, we said the bond will sell at par, right? So if the RD is 10% and the coupon rate is the same, this horizontal line gives the value of the bond at maturity. Until maturity, it will be sold at par, right, at the face value. And if the interest rate is 7%, we said that the bond will sell at a premium, right? We said the bond will sell at a premium if the interest rate is less than the coupon rate. If the interest rate is less than the coupon rate, the bond will sell at a premium, right? So the value of the bond will be higher than the face value. The value of the bond will be higher than face value, right? So when the time is passing, this value will gradually near the face value. Near the face value. It will gradually come towards the face value because at maturity, you can get only 1,000 rupees, right? Now, say, for example, if a person purchases this bond, right, market price is this much, but when it is nearing maturity, the company will pay 1,000 rupees to the bondholder. So, at maturity, it should reach 1,000 rupees or the face value. So, when you have time to pass, right? So at lower interest rates, bond will sell at a sell at a premium. But with the time passing and when the maturity is nearing, it will gradually slow down, come down to the face value, because at maturity anyway you will receive only the face value, right? So with time it is coming down, so you can make the calculations on at intervals and check if you like, as proof. And on the other hand, if the interest rate or the discount rate is greater than the coupon rate, if it is greater than the coupon rate, we said that the bond will sell at a discount. The bond will sell at a discount. And when time passes, right? When time passes, anyway at maturity, they will get 1,000 rupees for this. They will get 1,000 rupees. So towards maturity, it will gradually grow. The price will gradually grow and reach the face value at maturity. Right? Reach the face value at maturity. Right? See, bond value versus years remaining to maturity. At maturity, the value of any bond must equal its par value. Maturity, the value of any bond must equal its par value, right? Because the company will pay them the par value, not anything more, not anything less. The value of a premium bond would decrease to rupees 1,000, and the value of a discount bond would increase to 1,000, right? A par bond stays at 1,000 if RD remains constant, right? So what happens is, now, if the bond is selling at a discount, anybody would demand, thinking that they can get 1,000 at maturity, right? But if the now the time is nearing, right? Nobody would want to buy it at a, now say the seller will not sell it at a higher discount, because by waiting for a short while he can get 1,000, right? So the price would push upwards. Price would push upwards. Okay. And on the other hand, here the price. Now, what is this question? Now bondholder not getting any return for a zero coupon bond for the investment. Some person is asking. Now, the benefit is getting at the beginning. Discount bond or the zero coupon bond means the bond will be sold below par, and at maturity he will get the par value, right? So zero coupon or discount bond is, the bond will be sold at a discount at the very beginning. As I said, the 1,000 rupee face value bond will be sold at 850. You keep it till maturity, you can get 1,000. So the difference between 1,000 and 850 is the benefit that the holder gets. Okay? Understood? Okay, thanks a lot. Right. So a premium bond, right? So will not be able to sell at higher prices, because a person who purchases it will have only 1,000 at maturity. So nearing maturity, the demand for this bond will come down, right? Demand for this bond will come down and the price will decline to the face value. Summary of bond price and interest rate relationships. If market rate of interest increases above the stated coupon rate, then bond price falls and sells at a discount, right? So we saw it. 10% coupon rate, 10% discount rate, the bond is selling at 1,000 or the face value. The interest rate or the discount rate goes up to 13% and the bond will sell below par, right? Interest rate increases, it will sell at a discount. If the market rate of interest drops below the stated rate, then bond prices increases and sell at a premium, right? If the interest rate drops, then it will sell at a premium. So we can conclude that there is an inverse relationship between market rate and the bond price, right? There is an inverse relationship between the market rate, discount rate, and the bond price, right? So, yes. Then we move on to a new concept. What is yield to maturity? What is yield to maturity? Definitions are given. YTM, you call it YTM in shortened form, yield to maturity, is the rate of return earned on a bond held until maturity. It's the rate of return earned if the bond is held until maturity. You also called promised yield, right? Or another definition, YTM is the discount rate that make the present value of future cash flows equal to the price of the bond today. YTM is the discount rate that make the present value of future cash flows equal to the price of the bond today, right? So it is the discount rate that gives you the market price as the value of the bond, right? It assumes the bond will not default. So we define yield to maturity as the interest rate that gives you the market value, assuming that the bond will not default, right? Okay. YTM on a 10-year, 9% annual coupon, rupees 1,000 par value bond, selling for 887, right? Selling for 887. So what will be the yield to maturity, right? Yield to maturity. Yield to maturity is the interest rate that gives you the market value as the present value, right? So we know the present value now. Selling for 887 is the present value. 887 is the present value. And this is a 10-year 9% annual coupon. So for this bond with of base value 1,000, 9% will be received as coupon. So the periodic payment for the 10-year period on an annual basis will be 9% of 1,000 is 90 rupees, right? So you will receive 90 rupees on an annual basis for a time period of 10 years. And at the end of 10 years, you will receive the face value, right? Now, what the rate that would give these two cash flows present value as the market rate is the yield to maturity. So we have to find R. That gives us 887, right? 887. So how shall we go about doing it? How shall we go about doing it? I will show you the calculation. Now we get 90. 90 for a period of 10 years. First cash flow. First cash flow is 90 rupees. This is an annuity. 1 minus 1 over 1 plus R. R we have to find. 1 plus R to the power 10, right? Divided by R again. And plus the second cash flow is 1,000 rupees divided by 1 plus R to the power 10, right? And this has to equal the market price, 887, isn't it? Yeah, 887. So what is the value of R which would satisfy this condition? Right? That R is called the YTM. YTM. So if you are doing it by hand, yes. Thank you very much. If you are doing it by hand, you have to use the procedure called trial and error. Trial and error. So last week also we tried one trial and error, I guess, right? So trial and error is you substitute a value for R and then calculate the present value, right? Value for R and then calculate the present value. And depending on that value, what you get, you compare it 887. If the value that you get is less than 887, you must reduce the R that you selected. Reduce the value of R that you selected and try again to reach some amount that is closer to 887, right? Or else, now if your guess, the guess R gives you a, a value that is greater than 887, then you have to increase R, increase the value that you got, and find a value that is close, that gives a closer value to 887. So that is if you do it by hand, you call it the trial and error method, right? If not, you can use the calculator and then solve for R, right? So one person has done that for me. He or she tells me that it's 10.91. So 10.91, we can take it as approximately 11%. Approximately, we can take it as 11%, right? So this is how you calculate the yield to maturity. So yield to maturity is the rate that gives you the market value as the value of the bond, right? So find YTM if price were 1,134 and 20 cents, right? Find YTM if price were rupees 1,134 and 20 cents. So it's the same procedure. Can anyone help me for that? Now, in place of 887, we have something else. So 90 into 1 minus 1 over 1 plus R to the power 10 plus the second cash flow 1000 divided by 1 plus R to the power 10, right? Which gives you 1134 1134 and 20 cents. 1124 and I'm sorry, I think I made a mistake. 1134 and 20 cents. 34 and 20 cents, right? So what rate would give you a market value of 1134 and 20 cents? So I'm asking you a question. Should it be greater than 11% or less than 11%? Should it be greater than 11% or less than 11%? Yes. Yes, very correct. It has to be something less than 11%. It has to be something less than 11%. So if you are making the guess, the first guess, you can say okay, it has to be less than 11%. And 1 point. Now, if it is 10%, if it is sorry, it's 9%, isn't it? Now it has to be, if it is 9%, it will sell at par. So it has to be greater than 9%. It has to be greater than 9% because it is selling at a premium. And it has to be less than 11%. So it has to be something between 9% and between 9% and 11%, right? 11%. So that's a good guess between, right? Between 9% and 11%. You can try and then find the exact R that gives you 1134 and 20 cents. Okay? Understand? Right? So bond value versus the yield rate. Bond value versus the yield rate. Yield rate is the rate that gives you the market value of the bond, right? Where that gives you the market value of the bond. If the coupon rate is less than the yield rate, bond sells at a discount. If the coupon rate is less than the yield rate, bond sells at a discount. If the coupon rate is equal the bonds rate, it will sell at par or face value. If the coupon rate is greater than the yield rate, bond will sell at a premium, right? At a premium. If RD rises, if the yield rate rises, price will fall, right? Price fall, right? So price will be par at maturity, right? At maturity, price will be equal to the face value, right? That is a summary of the relationship between the yield rate and the coupon rate, right? So if you like simply put this in your head, it's easy for you to if you now say if you want to make a guess, then these principles should come to your head and you use this and then decide on a interest rate for the trial and error method, right? Then we move on to something related to yield to maturity. We are going to dissect yield to maturity and see yield to maturity versus yield to call versus current yield versus annualized return. Right? YTM, yield to maturity, is the yearly rate of return if bond is held to maturity. So this we learned. It's the yearly rate of return if the bond is held until maturity is called YTM. Includes both interest payment component and capital gain over the life of the bond. So return has two components. One is the interest payment. The second is the capital gain or loss, right? So both are included in YTM. Also is market rate of interest. So this is the market rate of interest or the rate of interest that gives you the market rate, right? Then in contrast, what is yield to call? Yield to call. Yearly percentage return or rate of return earned on bond until it is called, right? So if it is a callable bond, yearly rate of return earned until it is being called. Until it is being called is called yield to call, right? Then what is called current yield or the interest yield is calculated as the monthly payment, right? The coupon payment divided by the price, right? Payment divided by the price. Yield is calculated by payment divided by the price. An annualized return reflects only a 1 year holding period. So what is the rate of return? The bond is held for 1 year. Right? The bond is held for 1 year. So the calculations or definitions. Second, please. Okay, definitions. Current yield. Current yield is calculated as annual coupon payment divided by the current price. Annual coupon payment divided by the current price will give you the current yield. Then capital gains yield is the change in price. Change in price divided by the beginning price. Right? Change in price is the difference between the beginning of the period price and the end of the period price. So difference or the change in price divided by the beginning price will give you capital gains yield. Then expected total return or YTM, right, which includes both these components, equals expected current yield plus expected capital gains yield, right? Expected total return or the yield to maturity equals expected current yield plus the expected capital gains yield, right? So let's look at a calculation. Let's look at a calculation. 9% coupon, 10-year bond, price is 887. YTM we calculated as 10.91. So what will be the current yield? Current yield. Let's look at the definition. Current yield is calculated as annual coupon payment divided by current price. Annual coupon payment divided by current price. Now, 9% coupon on a bond which sells at 1,000, the annual payment is 90 rupees. It's 90 rupees divided by the current price. Divided by the current price will give you 887. So, current yield equals 0.1015. Expressed as a percentage, it will be 10.15. The current yield is 10.15. Yes.
Madam, can you tell us again, how did you take that 90 rupees?
90 rupees is now, sorry, one piece of information is not specifically stated here. That is face value equals 1,000. We took the same example as earlier. Right? So always interest or the coupon is calculated on face value. 9% coupon on 1,000 rupees face value. That is, annual coupon will be 9% of 1,000 is 90. Right? That is how we took the 90. Understand?
Yes, madam.
Okay. Right? So 10.15 is the current yield. Now we know yield to maturity is given. We have already calculated it. Right? So one of you gave me the answer 10.91, which is very correct. Right? So yield to maturity is 10.91 and we know the current yield. So if we now YTM equals current yield plus the capital gain yield, right, from here, right? So what we can do is when we know the YTM, know the current yield, and then we can solve for capital gains yield, right? So capital gain yield will be YTM minus the current yield, right? That is 10.91% minus 10.15%, that is 0.76. So capital gain yield is 0.76%, right? So this we can calculate like this also. Could also find values in years 1 and 2. Get the difference and divide by value in year 1. So you get the same answer, right? So we defined capital gains yield as change in price divided by beginning price. So end of the year price. If we can calculate the end of the year price, then we can find the difference and then divide by the beginning of the period price, then we should get the same answer, right? Then we move on to semi-annual bonds. Now what happens? All this time we were talking about bonds giving an annual coupon, right? So sometimes bonds may give semi-annual coupons, right? Semi-annual. So I'm sure you can remember the semi-annual compounding. Right? In that we said the formula has to be adjusted by, now if it is semi-annual, you double the time period, right? Multiply n by 2. And the other thing, you divide the interest rate by 2. Right? So multiply years by 2 and get periods equals 2n. Divide nominal rate by 2 to get periodic rate RD divided by 2. Right? So divide annual interest by 2 to get the payment. That is interest divided by 2. right? So let's look at an example. Value of 10-year 10% coupon of semi-annual bond if RD is equals to 13%. RD equals to 13%. Here also face value is equals to 1000. Face value is equals to 1000. Right? So how are we to find the value? Value of a 10-year bond. Right? How are we to find the value? So let's see how we should go about doing it. Right? 10-year 10% coupon, semi-annual bond if discount rate is 13%, right? Now 10% coupon on future for face value 1000 is 100, but now 100 is divided by 2, right? Interest has to be divided by 2. So 100 divided by 2 is the periodic payment that we get, or 50, right? So this is equals to 50. So for the annuity, you get 50 into, it's a present value calculation, 1 minus 1 over, now 1 plus R. 1, sorry. 1 plus R is now 13, right? Has to be divided by 2 to the power 10. Divided by, again, R is 13%, has to be divided by 2, right? Okay. And the balance part, the second cash flow, at maturity you get 1000 divided by 1 plus, that is 1.13, sorry, it's not, it's 0.13. 1 plus 0.13 divided by 2 to the power 10. Right? So if you simplify this, you get the value of a semi-annual bond, which pays you 10% coupon, the market interest rate of 13%. Did you all get it? Did everyone understand that? You had to take the interest as half because they are paying it on a semi-annual basis. 10% paid, 5% each half yearly, right? So take the interest and divide it by 2, and interest rate, divided by 2, and this has to be multiplied by 2. 10 has to be multiplied by 2. 10 has to be multiplied, n has to be multiplied by 2, r has to be divided by 2. Yes, thank you very much for pointing it out. It should be 20, yeah. Okay, can anyone give me the answer, please? Yes, can anyone give me the answer, please? Okay. 834 and 72 cents. 834, 72 cents. Right. Thank you very much. Thank you very much. I hope you could follow. Now, at the exam, I will set 2 questions from the areas that I teach. Right. So last year I gave a question from bonds and time value and shares. Right. So this year also it will be the same. So it will be simple calculations like this. Right. So you can easily score marks on calculations, easier than the descriptive type of questions. So please understand the adjustments clearly, practice them, and do very well at the examination, right? So what I noticed was it was an online exam last time. Performance was not so good, right? Performance was not so good. So please practice this. Just try to understand the adjustments. Practice this so that you will be very easily scoring marks at the examination. So we come callable bonds and yield to call, right? Callable bonds and yield to call. So we talked about yield to call earlier also, right? So uh, callable bonds. We talk about the call provision, callable bonds. So if at the time of issue, if we have stated that this being the bonds can be called before maturity, you call them callable bonds, right? So for example, 10-year 10% semi-annual coupon. Rupees 100,000, sorry, rupees 1,000 par value bond is selling for 1,135 and 90 cents and 8% yield to maturity. Right? So it can be called after 5 years, 1,050. Right? Now, it will mature in 10 years. It can be called after 5 years. Right? Right? It can be called after 5 years for 1,050. Right? So yield to call. So yield to maturity, we know how to calculate. Yield to maturity, we know how to calculate. So yield to call equals, say, price of bond equals, now this is the summation of the interest. Now this is the present value of annuity formula has to be replaced here, plus instead of face value, we will have call price, right? Call price is how much? Call price is 1,050, right? Call price is 1,050 and you have to solve for RD. RD is the rate, yield to call, right? So N is number of years until the company can call the bond, and RD is the yield to call, right? RD is the yield to call. Okay. So the easiest way to find the yield to call on this bond is to put values into your calculator and take the solution, right? Take the solution. This is the easiest way, right? So this was the solution, right? So that is approximately 7.5%, right? So shall I give you a few minutes or 1 or 2 minutes for you to try give it a try? Yes. So if you want, you can also find the YTM. No, YTM is already given 8% yield to maturity, right? So that is the rate that will give you a present value of 1,135 and 90 cents, right? Yes, did you all get the answer? 7.5%. Yes. Are you all there? Of course, yes. Of course, yes. Now, yield to call. Yield to call is yield to call. There is yes. Price of the bond now. 1 yield to maturity, right, is calculated as, I'll take a new slide. How did we calculate? How did we calculate YTM? YTM, right? YTM is market price. Market price equals, this is the payment or interest, periodic payment multiplied by 1 minus 1 over 1 plus r to the power to the power n to the power n divided by r, right? Uh, yes, plus face value divided by, this is face value, not future value, right? So we may misinterpret. Face value divided by 1 plus r to the power n, right? This is this r equals YTM. Okay. Now yield to call is YTC. It's calculated as, right? It's calculated as yield to call sorry, YTC is calculated as, here is the call price. It's the call price, right? Call price, not the face value. So price of the bond, right? Price equals payment divided by, now this part is all the same, right? Let me copy that. Right? You see, and not face value. This is call price. Call price. In the example, it is in the example it is 1050, right? Call price. Hmm. Here, call price to the power here. This here R is YTC, yield to call TC. Yeah. Okay. The only thing is you have to simplify and solve for, right? Right. Okay. Then, if you bought bonds, would you be more likely to earn YTM or YTC? Now, uh, if you bought a bond, right, if you bought a bond, would you be more likely to earn the yield to maturity? That is the rate that you get if you hold it until maturity, or yield to call, right? So coupon rate was 10%, in YTC was 7.53 in our calculation, right? Could raise money, say coupon rate is 10%. Coupon rate is the rate that the issuer or issuing firm pays the bondholder. Right? Coupon rate is the rate that the issuing firm would pay the bondholder. Right? So in other words, it is cost of bond. right? In other words, it is cost of the bond for the company, right? It's the cost of the bond for the company. Now, coupon rate, yes, it is 10%. And yield to call that we calculate gives us a cost of 7.53, right? 7.53, right? So, pays money by selling new bonds, which pay 7.53. So, if it is the price is 1,053 call price, the rate is 7.53. It implies that if you issue bonds, you can earn that rate 7.53. Whereas you are paying 10% now. Are paying 10% now. So if you call it, and if you call and redeem those bonds, you can resell or reissue new bonds 0.53%. Right? So the company could thus replace bonds which pay 100 a year. If it is 10%, you have to pay 100 rupees on face value of 1,000. So which pay 100 a year, the bonds that pay only 75 and 30 cents a year. Right? So investors should expect call. Right? Investors should expect call. So there will be a call most probably. Uh, if the yield call is less than the coupon rate, right? So investors should expect call, hence YTC is 7.5%, not YTM 8%. So they are, but they get it will be 7.5% because the company will go redeem, since they are callable bonds, they will call the bonds and then reissue new bonds at a lesser interest rate. So investors may expect a call, right? Investors may expect a call. Okay. In general, if a bond sells at premium, in general, if a bond sells at a premium, then the coupon rate is greater than the market rate, right? Coupon rate is greater than the market rate. So a call is likely. If there is a call provision, call is likely, right? So expect earn YTC or yield to call on premium bonds, right? Premium bonds. Coupon rate is greater than the market interest rate. So it is very attractive for the investor, right? But not very attractive for the company who has issued it because they are paying more for no reason. When the market interest rate is lesser, they are paying more. So if there is a callable provision in the bond, call is likely. The company will call the bonds, right? Redeem them and then issue new bonds at yield to call. So on expect to earn yield to call on premium bonds and YTM on par and discount bonds. That is the other two types of bonds. Then impact of interest rates on bond price. Impact of interest rates on bond price and interest rate risk. Right? Impact of interest rates on bond price and interest rate risk. We saw that the bond price and the interest rates are inversely related. So in our calculations, we saw that higher interest rates will give us lower bond prices and lesser interest rates will give us higher bond prices, which implies that there is an inverse relationship between bond price and the interest rate. That is, if the market rate rise, the price of the bonds decline. If the market rates rise, the price of the bond decline. And if the market rates fall, the price of the bonds rise. This change of values of a bond, the result of change of interest rates is called the interest rate risk. So they are very commonly we ask short questions carrying 2-3 marks. As what is interest rate risk, right? So this is the change of values of a bond as a result of change of interest rates, which is called the interest rate risk, right? There may be short questions at the exam, very short questions carrying 2 or 3 marks on these things, right? Interest rate risk. Okay. So let's see, interest rate or price risk, because we are talking about the change in price for 1 year and 10-year 10% bonds. So we are trying to see the depending on the maturity of the bond, how the interest rate change is affected, or how the interest rate change or the interest rate risk is behaving, right? So interest rate risk is rising RD causes bond price to fall, right? So we have a table. First column gives different interest rates, 5%, 10%, and 15%, right? The second line gives the value of a 1 year bond, which carries a face value of 1,000, right? 10%, right? 10 coupon rate is 10%, maturity is 1 year, face value is 1,000 rupees. So at discounted at say RD, when RD is 5%, it is 1,048 because coupon rate is 10. This is lesser than that. In that case, the bond should sell at a premium. So if it is 10%, right, 10% coupon, if the interest rate is equal to the coupon rate, we know that the bond should sell at par or the face value. And if the interest rate is greater than the coupon rate, we know that the bond should sell at a discount, right? So we see 5% it is 1,048, 10% it is selling at par, and at 15% it is selling at a discount, which is 956. So we have calculated the percentage change of these three figures from changing from 5% to 10%, what is the percentage change? And this the second change from 10% to 15%, which is a 5% change again, what is the rate of change? And the same thing is calculated for a 10-year bond, right? 10-year bond. If the bond matures in 10 years and the coupon rate is 10% and the face value is 1,000, the discount rate of 5%, it is selling at 1,386. 10%, it is selling at par. And at 15%, it is selling at 749. So we have calculated the rate of change for the 10-year bond. So which is 38.6% and 25.1%. So if we graph these two figures, the percentage changes, we can see which bond, whether the 1-year bond or the 10-year bond, responds sharply for the rate of change in interest rate, right? So we see that the 10-year bond has a sharper or a stronger slope than the 1-year bond, right? 1-year bond looks, this is a flat line, represents the 1-year bond, and the one that gives us a steep slope represents the 10-year bond, right? 10-year bond. So our conclusion is the time to maturity, right? Time to maturity matters, right? It matters. So it behaves like, say, it gives a sharp change for a small change in the interest rate, right? A sharp change in the value due to a small change in the interest rate is seen for a bond with a longer maturity. Bond with a longer maturity, right? Understand? I hope you can get it, right? This is interest rate risk. So we've been talking about interest rate risk and maturity of the bond, right? And then we move on to another type of a risk, right? What is reinvestment rate risk? Reinvestment rate risk. Reinvestment rate risk. The risk that cash flows will have to be reinvested in the future at lower rates, reducing income. So what is reinvestment rate is the risk that cash flows will have to be reinvested in the future at lower rates, reducing, which will result in a reduction of income of the bondholder, right? Illustration. So let's look at this example. Suppose you just won 500,000 playing a lottery. You will invest the money and live off the interest. You buy a 1-year bond with a YTM of 10%, right? 1 year bond with a YTM of 10%, right? So your year one income will be 500,000 at 10%, will be 50,000. So at the end of the year, now it's a 1 year bond, you earn 50,000 as interest, and at the end of the year, you get back your capital. So the total amount that you have in your hand is 550,000, right? Say, for example, if rates fall to 3%, right? If rates fall to 3%, income will drop from 50,000 to 15,000. Now, 1 year has passed. You got the interest for the first year as 50,000, and then you invest it for the second year. Now, for the second year, what happens if the interest fall to 3%? Right? Interest fall to 3%. Income will drop from 50,000 to 15,000. Right? Now, compare it with a long-term bond. So had you bought a 30-year bond, income would have remained constant, right? Income would have remained constant. So reinvestment risk is higher for when you invest in short-term bonds, right? It's higher for when you invest in short-term bonds. Now, let's observe the common factors and the features of interest rate risk and the reinvestment rate risk. Interest rate risk is the risk of changing the price due to a change in interest rate. Reinvestment rate is the change in income of an investment due to a change in interest rate, right? So let's look at this. Long-term bonds have more interest rate risk, which affect the value of the portfolio. So this is what we are referring. Long-term bonds have more interest rate risk, which affect the value of the portfolio. And short-term bonds have more reinvestment rate risk, which affects the income of the investment, right? Which affects the income of the portfolio. Thus, no fixed rate bond can be considered totally risk-free, right? So no fixed rate bond can be considered totally risk-free, right? It's not risk-free. Even treasury bonds are exposed to both of these risks, right? One can minimize the interest rate risk. Here, IRR represents interest rate risk by holding short-term bonds, because interest rate risk is lower for short-term bonds. So one can avoid interest rate risk by investing in short-term bonds, right? And reinvestment rate risk by holding long-term bonds, right? Reinvestment rate by holding long-term bonds. But one cannot reduce both, right? Thus, bond portfolio managers try to balance these two risk exposures. So in their portfolios, they will have a portfolio containing short-term bonds as well as long-term bonds in order to manage both these types of risks, right? Both these types of risks. Then, why interest rates are different for different bonds? Why interest rates are different for different bonds? Why interest rates are different for different bonds, right? Now, RD, or the discount rate, or the general interest rate that is used to discount the cash flows, comprises of the following, right? What is R star? R star is the real risk-free rate. The real risk-free rate, right? Now, this has to be added by different components to represent different types of risks, right? And the total, the final RD, or the discount rate, is comprised of, or is a representation of, different types of risks. Plus DRP is default risk premium. Now, this is the real rate, risk-free rate. Then you have to add the default risk premium, and that is risk for default, right? Then plus the liquidity premium, right? How liquid is the bond, liquidity premium. And IP is the inflation premium, right? This is allocation for general inflation. Then MRP is maturity risk premium, that is for uh, holding it for a longer time period or buying a bond with a long maturity, right? So all this together makes the discount rate of RD, right? And premiums added to R star or real risk-free rate for different types of debt, for different types of debt, right? So all is not added for all types of uh, right. So let's see what are the relevant types of um, rates, right? Short-term treasury securities. Short-term treasury securities, for the real rate, they will add inflation premium for short-term inflation, because short-term treasury bonds will mature in very short term. So real rate plus a rate for short-term inflation only will be added as, as the rate for short-term treasury securities or bills. Then long-term treasury, inflation premium for long-term inflation, right? Inflation premium for long-term inflation, and the maturity risk premium, because it's a long-term treasury bond or a security. Maturity is long, so MRP is added, right? Then short-term corporate securities. What are the risk components added? For short-term inflation premium. Then there will be a default risk premium. Unlike for the treasury securities, operations may default, right? So a default risk premium is added, and depending on the corporation, the liquidity premium will be different. So liquidity premium will be added, right? If it is long-term corporate bonds, right, then inflation premium for long-term inflation will be added, default risk premium will be added, and MRP, maturity risk premium, will be added because it's a long-term, right? And liquidity premium will be added because it's a firm, right? So how strong the company's instruments are, like say how quickly you can convert them into cash, represents liquidity premium, right? So these are different types of rates, and for and to real rate, different components are added depending on the type of the security, depending on the type of the security, right? So let's see risk structure of interest rates, risk structure of interest rates, bond spreads, default risk premium, and the liquidity premium. So let's look at is called a bond spread. What is called a bond spread? Bond spread is often calculated as the difference between a corporate bond's yield and the treasury securities yield. Right? It's the difference between a corporate bond's yield and a treasury securities yield of the same maturity. Right? Of the same maturity. Difference between a corporate bond's yield and a treasury securities yield of the same maturity. Therefore, spread comprises of default risk premium and liquidity premium. Now, if you compare these two, short-term treasury and short-term corporate, you will have inflation premium for short-term treasury, and in addition to inflation premium for corporate short-term securities, there is default risk premium and liquidity premium. So if you take long-term treasury and long-term corporate, you will have inflation premium on both for long-term, right? And then the default risk premium and liquidity premium for corporates, and MRP for both, right? So the difference comprises of the default risk premium and liquidity premium. So spread can be explained by the default risk premium and the liquidity premium, right? So bonds of large, strong companies often have very small liquidity premiums. So large, strong companies, nobody will be hesitant to buy a bond of, of such a company. So liquidity premium is very low, right? Very low. Bonds of small companies often have liquidity premiums as high as 2%, right? So as high, right? Say we may forget 2%, right? Yes. Yeah. So this is about the bond spread, uh, right? This is about the bond spread. And then let's look at a bonds rating. Look at the bonds rating. Let's look at the bonds rating. A bond rating is a letter grade. A bond rating is a letter grade assigned to bonds. It's a letter grade assigned to bonds that indicate their credit quality. That indicates their credit quality. Private independent rating services such as Standard and Poor's, Moody's Investors Service, and Fitch Ratings um, evaluate a bond issuer's financial strength or its ability to pay a bond's principal and interest in a timely fashion. Right. So there are independent rating agencies who use a systematic procedure of evaluating firms' ability to pay their debt, right? Ability to pay their bonds principal and interest. And based on that, they will put you in a classification of a lettered grade, right? So if you look at Moody's, you say you can divide them into two, investment grade and junk bonds. Junk bonds are the risky bonds, right? Risky ones. Investment grade are recommended. So Moody's give a rating called capital A and simple, followed by simple A, like triple A, double A, and B double A. Standard and Poor's gives us rates as ratings as this all capital, right? So until B double A and B double B of S&P, you consider as investment grade, which implies that you recommend that there is less default risk. But if it falls below that, they are called junk bonds, which implies BA and lower, BB and lower for Standard and Poor's, which implies that they are highly risky, right? So we also have our own ratings with an L in the front, right? Uh, you can refer and find the Sri Lankan the rating system, right? So I'm sure you have seen in newspapers some banks say, so we have this rating, we have obtained triple B. Likewise, they advertise and ask when they ask you to buy their securities. Yes, that is a rating. Then bond rating and bond spreads. This is an example withdrawn data from Yahoo Finance, right? Long-term bonds and U.S. Treasury, right? U.S. Treasury bills pay 5.25, and we have calculated the spread. Spread is the difference between the corporate bond and the Treasury bond, right? So triple A yields 6.26. Compare it with 5.25, the difference. So spread is 1.01. Double A, the rate is 6.42. Take the difference, it gives you 1.17. So likewise, we have calculated bond spread for starting from triple A up to triple C, right? So down the line, you see the spread increases with the bond rating declines, right? The bond rating decreases, the spread increases. That is the amount added as the risk premium increases when the rating of the bond decreases, right? Which is quite natural because you have to cover up the risk, right? Right? The required rate of return is the real rate plus the risk premium, right? So risk premium has to be more for the ones which are risky, right? Then, what factors affect default risk and bond ratings? What factors affect default risk and bond ratings, right? So financial performance. is being calculated by these companies, financial performance by calculating different ratios, right? Different ratios. So better the ratio, higher the rating. Right? Then provisions in the bond contract. What factors affect default risk and bond ratings? Provisions in the bond contracts. Secured versus unsecured bonds. So if it is secured debt, say high value mortgage, if you that is secured by high value mortgage, then rating is enhanced. Senior versus subordinated, right? Debt not subordinated, have other debt subordinated to it, will have a better ratings. That is, subordinated bonds is two categories of bonds are issued with the guarantee of the same set of assets, right? So senior one is the stronger. So the category is the subordinated bond, which is guaranteed by the same set of assets. So if something happens and they have to sell the assets, the senior bondholders will get priority in receiving that money compared to the subordinated debt holders. Right? So no subordinated debt will increase the rating. Then guarantee provisions, debt guaranteed by other firms, right? If by a strong firm, bond gets the strong company ratings. Then sinking fund provisions is a plus factor in rating, right? Sinking fund gives an assurance that money will be, you are ready with the money to be paid at maturity. Then debt maturity, shorter is less risky. Yes. Then what factors affect default risk and bond ratings? Other factors that may have an effect. So we talked about financial performance, and then we talked about the provisions in the bond contract that may have an influence, and then other factors, earning stability. Stable sales and earnings will enhance the rating. Regulatory environment. So whether it's adverse or favorable. So favorable will enhance the ratings. Potential product liability. Say, for example, are the products safe? Now, say, for example, a company producing tobacco-related products, right, will have that influence, a negative influence on the ratings, right? Potential product liability. Accounting policies. Conservative accounting policies is a plus factor in ratings, right? So it's about ratings and the default risk, right? Then let's compare treasury yields and corporate yields. Treasury yields and corporate yields. Corporate yield curves are higher than that of treasury bond, right? Corporate yield curves are higher than that of treasury bond. However, corporate yield curves are not necessarily parallel to the treasury curve. It doesn't have to be necessarily parallel. The spread between a corporate yield curve and the treasury curve widens. Corporate bond rating decreases. So if the bond rating decreases, that widens. Now in the graph, you see on the vertical axis you have interest rate. In the horizontal axis you have years to maturity. Green line shows the interest rate for a treasury bond. Green line shows the interest rate for a treasury bond. So yellow line shows the relationship between years to maturity and interest rate, which is called the yield curve for a AAA bond. Red line shows the same thing for a double B bond. So you see the gap. The gap widens when the rating becomes weak. Right? The gap widens when the rating becomes weak. Okay. Then term structure of interest rates, right? For maturity risk premium, inflation premium, term structure of interest rates. Let's see what is meant by term structure of interest rates. The relationship between interest rates and maturities, right? The relationship between interest rates and maturities is called the term structure of interest rates, right? Pure time value of money for different lengths of time, right? A graph of the term structure is called the yield curve. Graph of the term structure is called the yield curve, right? So yield to maturity in the horizontal axis, interest in the vertical axis. The green proportion indicates the real interest rate, right? So yellow section shows the inflation premium and the red section shows the maturity risk premium, right? So it increases as as the bonds maturity is longer, right? Then three components determines the shape of the term structure, right? Term structure. The real rate of interest. So the real rate will have an influence on the shape of the term structure, right? Rate of inflation. Prospect of future inflation of if high, long-term rates will be higher. Prospects of future inflation, right? Prospects of inflation, future inflation, if high, long-term rates will be higher, right? So if low, long-term rates will be low, right? If high, long-term rates will be high. So you will see here prospects, future prospects will be inflation high, so it is increasing. Here the future prospects is inflation low, so it's decreasing, right? Then the third factor, interest rate risk longer. Longer term bonds have much greater risk of loss from changes in interest rates, right? So interest rate risk, longer term bonds have much greater risk of loss from interest rates. So you see that longer term bonds, the risk of maturity risk is higher. So on this, yeah, with longer term, you have higher maturity risk, right? So this is how the term structure behaves. Okay. And then why long-term rates are higher, right? Explanation based on liquidity preference theory. Why long-term rates are higher, right? Why long-term rates are higher? Let's see why, right? Investors prefer short-term deposits, higher liquidity, right? So investors do not like to lock their money for a longer time period, right? They expect higher liquidity. Borrowers prefer long-term fixed rate. So from the side of the borrowers, they would want to borrow at fixed rate for a longer time period, right? Now, financial institutions, in their intermediary function, right? It is difficult to finance. Now, people would want to deposit short term and people or the firms would want to borrow long term. So they will find it difficult to finance long term fixed rate loans with short term deposits, right? Will be difficult. So in practice, what financial institutions do is raise long term rates relative to expected future short term rates, right? So this reduces, right, the demand for long-term fixed rate borrowing and encourage long-term deposits, right? So in practice, financial institutions raise long-term rates, relative to future short-term rates, right? So when long-term rates are higher, people will be encouraged to increase long-term deposits. And when it will reduce, since the rates are higher, it will reduce the demand for long-term fixed rates, right? Encourage deposits, discourage loans. The liquidity preference theory leads to higher rates for long-term bonds. So that's the explanation behind the liquidity preference theory, which you explain that long-term rates will be higher than the short-term rates, right? So, yes. So this is from here onwards, it's a small case, and you will be asked to answer some questions covering all what we have discussed in the lesson, right? Covering all what we have discussed in the lesson, and these are not difficult questions. These are not difficult questions. So I would like you to attempt them by your own self. And if you have problems, right? So since some people couldn't hear me, and sometimes with the this problem of power supply, so we had to depend on a recording instead of a undisturbed lecture, right? So since there have been many problems, I would encourage you to communicate with me via the email if you have any questions, right? So I didn't think of giving you a break today because we had a break, unexpected break due to the power cut, right? So uh, thus I didn't give you a break. So since almost it's 11 o'clock, I think we can stop this lesson. Next week, I will discuss the stock valuation, which is the last lesson by me. And we may, like say, I may finish off for the semester time. So there'll be two questions from my section, these three sections. So as I reminded you, you can clarify any, like say, um, whatever problems you come across when going through the recording and the lesson again, right? So have a clear idea about the time valid concept, because we are using the time valid concept in the valuation procedure. So let's talk about stock valuation next week, and we'll be using the time value concept in stock valuation also. So I think we can wind up at this moment, right? And thank you. Yes.
Madam, small thing.
Yeah.
Before or after winding up your lecture series, madam, is it possible to discuss or explain at least a recent past paper question relevant to your areas, madam?
Yeah, not a big problem. So once we finish the stock valuation, right? So if you have past papers, please go through and collect the relevant questions, right? So I've been teaching here for about 3 years, so I can bring whatever I have put in as questions. So you can bring whatever you can find. So once we finish stock valuation, we can have a little more time and then discuss whatever problems you have. It's not a problem at all. Yeah, we can do that.
Thank you so much, madam.
Okay, thank you very much for bearing up with me. Right, thank you. Thank you very much.
Thank you, madam.
Thank you, madam.
Okay.
Madam.
Okay.
Thank you, madam.
Thank you.
Okay. Have a nice weekend, all of you. Right.